Good evening, everyone. This is Veer Maheshwar Charitable Trust Latur MS India organizing daily international webinar series. This series is running 5 years and the speakers are invited from India and abroad. The speakers invited are mostly women resource persons. So this is the basically empowerment series. This series recognizes the Indian Book of Record, Asian Book of Record, and International Book of Record recognized as awards on continuous organization of the webinar series, daily webinar series, maximum webinar we have been organized and we are daily organizing it. The topics are covered related to education, law, finance, environment, technology. All topics are related to these heads are accepted here. Today we have invited Dr. Puja Kaushik Madam from Rajeev Gandhi College of Management Studies, Navi Mumbai. And her topic is behavioral finance. I welcome you, ma'am, from my organization and from all the participants. She is an active teacher in the college, in the NAC, and invited by the various organizations as a keynote speaker. Basically, Rajiv Gandhi College of Management Studies, Navi Mumbai, supported in this series. Various speakers from this college already delivered, and today also Dr. Puja Kaushik Madam going to deliver the topic of behavioral finance. I welcome you, ma'am, and welcome all the participants, those who are joined here. And I request you, you can start your speech.
Hi, everyone. Very good evening. Basically, the topic that I'm going on is behavioral finance. What is behavioral finance according to you? Today, nowadays, we are having an opinion. We are having the things that uh, the war-like situation is going on between Iran, Iraq, and certain other countries. So, what we think about that? Gas nahi milega, petrol nahi milega. So, we are having some sort of an opinion ki what we need to do in this aspect. Supposingly, any company who is going on with producing of gas or producing of petroleum products, the share prices of that very particular organization may increase or they may decrease based on our own behavior. So, the today's topic that we are going to cover is the behavioral finance. As the first page of the behavioral finance itself reflects. Just give me a second, sir. Yeah, thank you. The first point of behavioral finance that I'm going to deal on with. Just give me a second, sir. It is not moving up. Now, is it visible? Yes, sir. Thank you. Thank you. Why behavioral finance we have to study? The first point that we are covering up in this point is the conventional or modern finance is based on rational and logical theories such as capital asset pricing model and efficient market hypothesis. These theories assume that the people of for most part behave rationally and are predictable. War-like situation, petrol will be expensive. We may be getting, we may not be getting a number of things that we are having. One of the most rudimentary assumptions that conventional economics and finance market is that people are rational, wealth maximizers who seek to increase their own well-being. Behavioral finance seeks to explain our action, whereas modern finance seeks to explain the actions of the economic man. So here comes the first of all the introduction. Why markets are always rational. In behavioral finance, what do we really mean? It is a study of psychological factors on financial decision making. What are psychological factors? Any sort of XYZ incident that happened with an individual or happened at a large scale, any of that factor is going to make some sort of an effect on your behavior of deciding or not to decide about any particular company, about any particular product, or about any XYZ factor. such decisions that you are going to make based on such factors, such psychological factors, such in total is termed as behavioral finance. So it attempts to answer the question why stock market anomalies, abnormal trends arises and persist for some period of time. Nowadays, we are finding out in our country, India, the biggest market that we can see is the wedding market. Why? The best color that we select is from the trend. It is from what we hear from others. अच्छा कियारा ने क्या पहना था, अच्छा XYZ actress or actor, what they have worn, who are our own, the persons who influence our life, what they have worn, that will be the behavior that is going to set. So in the same way, we are going to set those sort of behaviors in the financial market as well. So such abnormal trends arise and persist for us for some period of time because human beings' memory being little short, we only remember what is there in our current, unless and until we do not pressurize on getting that what has been the news, what we have done in the last 15 days, what has been the trend, what has been the news. The highlighted only points we remember, whereas the other things that had happened, we ignore them. It uses psychological financial theory to understand how information structure and nature of market participants can systematically influence the individual investment decision as well as financial market outcome. So, in summary, we can say behavioral finance is nothing just the structure of market information, which is added up with the nature of the market participants, any XYZ. It is the nature of the market participant is going to decide about the individual decisions and market outcomes. Every day we are finding Trump came to the screen, he said war is over. Whenever he says war is over, the market goes up. Wherever we are finding out a news, nahi, Iran hasn't has stopped the war, still it is going on. आज दो बॉम्ब गिर गए, आज चार गिर गए, आज ये हो गया, आज वो हो गया, अगेन द मार्केट फेल्स डाउन. कोई भी एक नेगेटिव न्यूज आती है, सेंटिमेंट्स होते हैं, market falls down. The reason is it about the behavioral finance. Behavioral finance is a subfield of behavioral economics that proposes psychology based theories to explain stock market abnormalities such as severe rise or fall in stock prices. Behavioral finance is the field that studies how psychological factors and emotions influence financial decisions. Why do we study that? What is the purpose of studying that? That is identifying and understanding why people make certain financial choices. Because nowadays, whenever we are going to analyze the market, whenever we are going to analyze about any XYZ business, that whether it is going to come up or it is not going to come up, we will find it through behavioral finance, through the pedagogy that our consumers are going to adopt their future. As per Daniel Kahneman, who has been the Nobel Prize winner, he has given up two systems, system 1 and system 2. In system 1, that is by default, we takes very fast decision. Those decisions are there in our subconscious mind. We are automatic to it. Everyday decisions, we can take it very easily and they are error prone. Whereas system 2, they are little slow. We need some sort of conscious things, effortful, complex decisions and reliable. Every day we have to wake up, we have to go to a college, we have to do the lectures, we have to take the sessions, various other activities, whatever are given to us. We have to do such activities, we have to come back to home. And again, with our home household chores, we have to furnish. And then we are coming back, getting ready ourselves for the next day. Whereas for system 2, if the schedule has changed, if you are going for some vacation period, to the system 2, it is little slow. If you are going at your relative's place, that is little slow. और every day I do the trade. जब भी market थोड़ा सा 2 point नीचे जाएगा, I'm going to buy the particular thing. 4 point ऊपर जाने पे I'm going to sell it. But if it is flowing neither between those 2 and 4 points, it is going in 0.25, 0.5, 0.25, 0.5. Then System 2 will come into existence. That is slow. We need to think about, we need to have a conscious thinking process needs to be followed, that now what we have to do, that is effortful, that is little complex, decisions are based on it, but that is little reliable. Yes, because we are giving up our time. So Daniel Kahneman has said that whenever the normal tendency is going on, behavioral finance is going to react in the same way every day. But with a little change, or some bad or some positive point of a news comes into existence, one of your friend has said any XYZ thing to you, system 2 will come into existence. And that is going to make an effect in the decision that you are going to make out. Behavioral finances are having the components like heuristic, they are having biases and market impact. Heuristic, what does heuristic means? Heuristic biases in behavioral finance means some sort of anchoring biases. Anchors come to the screen, they speaks out about particular XYZ company. अरे बायजूस का जो शेयर है वो IPO launch हुआ है and that is flying up very high. No doubt Byju's is no more existing nowadays, but still anchors have said and we have applied for it at that time when the IPO was launched. An investor buys a stock of at rupees 1000 even when its value has dropped to 700 rupees due to poor performance. The sellers refuse, or those holders of the shares, they refuse to sell because they are anchored to rupees 1000. नहीं अब तो जाएगा ही जाएगा 1000 रुपए. Next is under heuristic, we are having availability bias. Availability bias means decisions based on easily available or recent information that is available to us. After hearing frequent news about a tech company's success, an investor's bias stock without proper research. AI का जमाना है, सबकी jobs ले जाएगा. So each and every XYZ person is thinking about AI and going to work on that AI. AI नाम से अगर कोई शेयर भी अगर आ जाएगा या IPO करके लॉन्च करेगा, we all are going to buy it blindly because that is the heuristic approach. Availability bias. The next is representative bias. Judging based on stereotypes of past patterns. नहीं पास्ट में ऐसा हुआ था, वो 200 गया था, 200 के बाद में 180 आता ही आता है. They are based on the past patterns. If the company has performed well in the past and investors assumes it, always perform well and invest blindly on it. The next is overconfidence bias. Overconfidence bias means believing that too much in one's own knowledge or ability. I have already decided and what I have decided is full and final and that is always correct. That is the overconfidence biasness that we are finding out. Loss aversion related to heuristic behavior, fear of loss more than a desire for gain. And investors hold a losing stock too long, hoping it to recover instead of cutting the losses. Herd behavior, buying stocks just because everyone else is investing in them during a market boom period. So heuristic approach, in conclusion, we can say it is a mental shortcut that simplifies the decision making, often leads to irrational financial decision. It is not at all based on any of the technical or fundamental analysis. It is only based on what others are saying and we are performing on it. The behavioral finance and understanding the investor psychology, we are trying to find out. Now, what are the biases in behavioral finance? The biases in behavioral finance are systematic errors that affect financial decision, leading to investors to act irrationally. Systematic errors means systematic errors in thinking. When you are filled with, overwhelmed up with any XYZ reason, you take irrational decision based on emotions and mental shortcuts, which leads to poor financial decision. In biases, in emotions, we are finding out as cognitive theories, cognitive biases. And the next is the market impact. The details of them will proceed further in the next slides. Heuristic, they act faster than rational deliberation, but precisely because of their speed, they can mislead into systematic error in making decision called biases. न्यूज चैनल में आ गया XYZ कंपनी का IPO निकला है, आपको तुरंत से खरीद लीजिए, नहीं तो कल को नहीं मिलेगा. और आज उसका अगर कॉस्ट 100 रुपीज बताया जा रहा है, then the near by future you will be finding it around to 2,000 rupees, it won't be available to you. So blindly listening to them, we invest the money. When does a bias occurs? When the people's actions are based on feelings or perceptions, but not on facts. Biases that we already said are of two types. They are emotional based. They are already of two types, cognitive and emotional. Cognitive means which are related to perception, memory, judgment, and reasoning. Whereas emotions means relating to sentiment. The next point, they are the classification of behavioral biases. The five categories that can shape the investor's decisions are heuristic and cognitive shortcuts, emotional biases, social biases, cognitive biases, and hindsight biases. Heuristic and cognitive shortcuts, what does they mean? They means mental shortcuts availability, like anchoring, what we already said, availability biases, representative biases, that leads to quick decision making. They are biased decisions. Emotional biases that are based on feelings or emotions of any xyz person, like fear, greed, regret, loss aversion, which causes investors to hold losers too long, avoiding rational exit. For example, loss aversions means fear of loss that may desire for gains. Now I am going to buy this thing. Maybe today it is falling down, but in the new next few years it is going to recover, and I'm going to make n number of amount from it. There were n number of people who have purchased some company shares who are no more existing now. There are certain case studies based on it, which we'll be discussing it further. The next is regret aversion. Regret aversion means under the emotional biases we are finding out, avoiding decisions due to fear of regret. We do not take such decisions because we are already having that today, if we are not going to prove ourselves, we are going to regret it future. So we leave certain opportunities. Endowment effect. Endowment effect means overvaluing the owned assets that we are already having the assets. They are overvalued according to us. Self-control bias, lack of discipline in financial planning. The next comes the social biases, which arises from influence of others. Desire to confirm, herding biases causes investors to follow crowd against their better judgment. We follow what others say. They are doing this, hence we have to do that. Nowadays, we are finding out, in spite of the jobs increasing out, what we are finding is we are finding medical colleges, management colleges, engineering colleges are increasing day by day. In every lane, we are finding such colleges. Why? How many number of students are taking admissions over there? They are the social biases. Mr. Sharma ji का बेटे ने ये काम किया. You have to do that. शर्मा जी का बेटा बन गए, social biases हो गया है. It is all about the social biases. Taking an example of Mr. Sharma ji ka beta. The next is our cognitive biases. Brain processing limits. Confirmation bias leads investors to ignore contradictory evidence entirely. We do not go with the process. We do not go with any sort of analysis. We bias on our own confirmation biases. We have asked, we got some tip. That tip is the cognitive bias. Hindsight bias means when we are finding out it, I know it all along, investors overestimate their ability to predict the past outcomes retrospectively. Hence, on the basis of these classification of behavioral finance, we can say understanding bias categories, first step is to rational decision making, which we have to do, but we are not doing that rational decision making. Some other common biases are overconfidence, loss aversion, herd behavior, anchoring, confirmation biases. Hence, we, on basis of these five and various other behavior patterns, we have made our behavioral finances under 8 categories. Those 8 categories are anchoring, overconfidence, loss aversion, herding, confirmation, mental accounting, availability, hindsight, and regency. Explaining each and every one. Anchoring means relying too heavily on first information, while making decision relying too much on initial information. The real life example is an investor buys a stock at rupees 1000 and refuses to sell at 800 even, believing it to return to 1000. I believe it. That is anchoring because it was already told in the news media by certain XYZ anchor to whom you believe has been the correct. Overconfidence bias. Overestimating one's knowledge or ability in decision making, excess belief in one's own ability. The real life example for it is a trader believes that they can always beat the market or take excessive risk, frequent trading, thinking, I can beat the market. I am the king of the market and I know how to do that. The next is the herding biases, following the crowd without independent analysis. People invest in trending IPOs just because everyone else is investing in it. Trending IPOs without analysis is herding behavior. Loss aversion, fear of losses, is stronger than despair or pleasure of gains. What does it mean? From the real life example, we are going to understand an investor holds a losing stock too long to avoid realizing the loss, holding losing stock too long. That I'm going to lose it, I'm not going to sell it. I'm going to hold it for a very long time period unless and until my loss is going to be minimized. But there is always a saying it is always better to cut your stocks or trades at a cutoff point. Exceeding to the losses point, you are going to bear a heavy amount of loss, which is not going to be fruitful for you. Confirmation bias. Seeking information that support existing beliefs and ignoring contradictory data, looking for supporting information only. An investor who only reads positive news about a company they invested in. Example, ignoring the negative news about the invested company. I love to wear some dresses from Ajio. So I will always look the positive side of Ajio. I won't go for the negative news of Ajio because I'm always inclined towards it. And my inclination will make it confirmed that yes, the company that I have selected in buying the share of Ajio, because I also buy the clothes of Ajio, hence Ajio is good and the share is going to rise high. That is the confirmation that I'm giving. No doubt that is irrelevant, but still the people believe on it, and they are the eight amongst the eight key behavioral biases that every investor does at the time of investment. The next is mental accounting. Treating money differently based on its source or purpose. For example, a person spends a bonus freely but saves the salary strictly. Whenever the bonus is coming to us, we spends it nicely. It is just a bonus. We'll be getting some more amount for it. The next is recency, giving more importance to recent news or over the historical data. It means the technical analysis is not done. Investors assume a stock will keep arising because it performed very well recently, investing based on recent market rise, not on the previous data. The next is the availability bias, making decisions based on easily available or recent information. The real life example for it, after hearing news about the market crash, investors avoid stocks completely, avoiding stocks after hearing crash news. Market is going to crash or the market has already crashed. We are not having any sort of availability biases. We are thinking about the decisions which are available on recent news. We are not thinking about any other decision at that time period. Now, there comes the classification of behavioral biases. They are under the certain categories. We have divided our investors' biases as self-deception, cognitive bias, emotional effect, and social effect. Till here, what we are finding out, what we are studying is how the market plays with the emotions of people, or how does the market plays with the emotions of investors. The emotions of investors are always connected whenever we are buying or selling any company's shares. And how does we had been played by that? The first point under the investor's biases is the self-deception. Under self-deception, what does it mean? It occurs when individuals mislead themselves to maintain the confidence or reduce the discomfort. For example, the key idea behind is people believe what they want to believe. You believe what you believe. You don't believe what the other says. What the truth is. Maybe what you are believing is 90% truth. What about the 10% that is not true? But still we believe because we believe on what we believe. That protects the ego and self-image. The example for it is first is the overconfidence. Overestimating the knowledge or skill. The real life example for it is investors believe they can pick winning stocks. They know they are having the knowledge. They are having a great knowledge that they only pick the winning stock. Then second point under the self-deception is self-attribution bias. Success is equal to own skill. My skill is only the success. Failure is equal to the external factors. Each and every credit of our success comes to me, and each and every uh, criteria of failure goes to others. Failure is because of the external factor, not because of me. Profit, I'm smart. Loss, market was very bad. Market never allows anyone to buy the shares. There were X number of uh, demat accounts increases at the time of COVID. Each and everyone was happy in having that amount of money. But when the market started little crashing down, or when the market started correcting itself, there were certain ones who has the trigger loss. In that scenario, what they said, market doesn't allow everyone to buy the money. It is always the bigger fish that eats us. It is not the bigger fish that eats us. It is always the fundamental and the technical analysis that helps them to buy that amount of money that we are not utilizing. We are only based उन्होंने क्या बताया शेयर फलानी कंपनी का शेयर आ रहा है इसका आईपीओ आ रहा है एंड वी हैव टू बाय दैट शेयर और आईपीओ इट इज नॉट ऑलवेज करेक्ट टू गो blindly on any XYZ person. The next is the hindsight bias. The hindsight bias means believing past events were predictable. After crashing, I knew it would happen, but still I've invested in it because I would like to judge myself that whether whatever I've done was correct or not. That was hindsight biases. Coming to the next one, that is cognitive biases. Results from error in thinking and information processing. What does it mean? It goes on with the anchoring biases, relying on initial information. For example, stock price at purchase affects the decision. That is the anchoring bias. Availability bias. Based on easily available information. Fear after hearing the market crash. Everyone will have that fear. Representative bias. But there are persons who makes money out of it at the time of availability bias, at the time of crashing of the market. Whenever the market is going to crash, what I, as per from the point of view of an investor, not my personal opinion, but from the point of view of being an investor, always to invest when the market is crashing. Because one or the other day it is going to recover. And once it is going to recover, we are going to earn the profit out of it. That is the cognitive bias. But what we think, not to invest in the money because it is crashing down. Pata nahi how long it is going to come down. And once it is going to come down, I'm going to lose my money. That is the point. Next is confirmation bias. Seeking support information only. Ignoring the negative news, as we already said. The next are the emotional biases, which arise due to feelings and impulses. The key driven factors for it are fear, greed, regret, ego. Harder to control. The various examples for it are first is loss aversion, fear of loss or gain, losing the stock. Regret aversion, avoiding regret, not investing after the past losses. It happened with me as well. I made a loss and I stopped investing my amount in that because I have that regret aversion. The next is the endowment effect, overvaluing owned assets, refusing to sell the owned stock. If it is coming down, again it will come up. I'm going to hold that stock with me for a longer time. Let it comes up. That is endowment effect. Self-control bias, lack of discipline, overspending instead of saving. That is self-control bias. The next are the social biases, which occurs due to influence of others or social pressure. The key idea behind such sort of biases are decision influenced by group behavior and trends. What Virat Kohli is doing, what our great personalities are doing, whom we are going to follow. Such herding biases, following the crowd, we do not take our own decision. Investing in trending IPO. Tomorrow there is an IPO coming up with Swiggy. There were a number of investors who invested up their amount. Byju's is going to take the whole market of the tuition sector. Nobody else is going to survive. It is only the Byju's who is going to survive. IPO was launched. People have invested a number of amount. Now what is the return that they are getting? But that was a herd mentality, herd biasness based on the social influencing factors. The next is authority bias, trusting experts blindly. The experts are coming on CNBC, Z News, Z Business, and all. We believe on such experts because the experts said we are not investing our own amount. It is just only our opinion, and we believe on them. Do we trust? Do we make a cross check whatever they are saying? Ki XYZ company is coming up and XYZ news is there. From where they have found that news? From our internal sources, we are saying, but we are not on saying it on our make the investment at your own decision or at your own risk. But they have said we ignore. So our brain does not goes on with that no factor. We always used to say no. Nobody is going to listen to that no. We do not remember that no. The sentence that we are going to speak, that our brain is going to remember. That is a social biasness. Bandgone effect. There is one more effect that is going on. Doing what others do. Sharma ji ka beta. That is bandgoing effect. Buying stocks because everyone is buying that. So I also have to buy that. Status quo buys. Preferring current situation, not changing the investment portfolio. So in summary, what we can say is self-deception is based on ego and self-belief. The next cognitive bias is based on thinking error. Emotional or affect biases are based on our feelings. And a social biases is based on influence of others. The next, what behavioral finance? It is the study of influence of psychology on behavior of investments or financial analyst. It includes the subsequent effects on market. So our behavioral finance is a combination of three things, not only psychological, but also of economics and finance. When we are going to grind these three things in one vessel, economics, psychology, and finance, we are getting the term as behavioral finance, which focuses that the investors are not only rational, they have limit to their self-control and are influenced by others' biases. And on the basis of others, what others are doing, they create their own decision. So that is termed as behavioral finance. There is another theory that we study this prospect theory. Under the prospect theory, what does this say? It is based on the Kahneman and Traversy, 1979, the cornerstone of behavioral finance. He was a Nobel Prize winner in the year 2002. He is having certain points. The reference points. The people evaluate outcomes as gains or losses relative to the reference point, not by the absolute wealth level. Reference point was given this much. When we are finding about the loss aversion, losses feels 2x times more painful, or more equivalent gains less feel pleasurable. If you are having a loss of 1 lakh rupees, it feels like how much I have lost in the market. But if you are gaining more or less the same amount, that energy or that devotion or that pleasure that you find out is little less. Probability weighing. People overweight small probabilities. They buy lottery, insurance, and underweight the large probabilities. They ignore the near certainties. As in the real world situation or application of this prospect theory in the real world life is Priya buys HDFC Bank at 1600 from a reference point. Now the stock is at 1800. That it means it has increased to 200 points. The behavior is sell quickly to lock it again. You need to sell out your shares and you need to get your profit amount of rupees 200. Risk aversion gains domain, cuts the winner's short, rides, loses comes. He is not going to sell that at 1800 because she is having a prospect that now she is going to earn more. So she doesn't sells it off. But when it comes to 1400, she is having a hope. She is praying to God, hey Bhagwan, come make it to 2000 so that I can bear that loss and I can put again. The behavior holds hoping to recover. Risk seeking in losses domains. Cuts the winner's short, ride losers long. As per the prospect theory, it explains the most common and costly investors' mistake in all the market that you do not want to sell off at a lesser profit and higher amount of loss or that equivalent amount of loss is not bearable to you. You think of getting it recovered so soon, but once the profit was there, we were not recovering it. We were having greed in our concept. There comes the next is framing bias. It is that having a tendency to interpret and evaluate the information based on how it is presented, not on its objective or merits. In the same fact, frame differently produces opposite decisions. For example, a positive frame and a negative frame. This surgery has 90% revival rate, whereas the surgery has 10% immortal rate. Which one would you like to prefer? Most people will choose the correct one, whereas the remaining one, only the 10% will think about the negative aspect of that. So, as per the finance application of this surgery, 90% revival and 10% critical or immortal, this we can say is the fund delivered positive returns is 8 out of 10 years. The fund lose 2 years out of 10 years. Same data, opposite investors' reaction. That is termed as framing bias. Only 10% of the persons will be, or the investors will be thinking about to invest in that particular company. This has only happened for the last 2 years, whereas for the remaining 8 years, or for 8 times, it has given me this amount of profit. But now, the aspect that we are having on it is only on the negative aspect. Coming on with the rational finance versus behavioral finance, we are finding out rational behavior and behavioral finances, how we invest in a particular organ, or how does our behavior impacts in having that behavioral finance. This image compares the two different approaches, which tries to make us understand how investors make decisions. First is the investors model, that is the rational finance, assumes people are homo economius, which means perfectly logical. Behavioral finance, under the heading of behavioral finance, we assume people are homo sapiens. What does it mean? They means emotional and biased. Okay. Some of them, 10% of them are homo economics, which goes on with their technical fundamental analysis, X number of data that they are going to find out. Whereas others, 90% are homo sapiens, only on emotional based. The next is the based on it, the real investors are not perfectly rational. They are human. The next, decision bias. Rational decisions are based on all available information and logic. Whereas under the behavioral finance, we are finding out decisions are influenced by heuristic, emotions, and biases. For example, fear or greed may override the logical thinking. The next, market price. Rational prices are always correct. They are the efficient market hypothesis that they have created. But whereas under behavioral finance, they can be wrong for exceeding periods, which means markets are not always perfectly efficient. Risk perception. Under rational, we can find out risks is measured objectively, probability based, whereas in the behavioral, risk is emotionally driven. Losses feel stronger than gains. As in the last framing theory, also, we have gone through the same. The next, market anomalies. It does not exist or are temporary. According to behavioral finance, anomalies are common and predictable. For example, stock bubbles and crashes due to herd behavior. These two theories were differently founded by different persons, great economists. Markowitz was the founder of rational economic finance, whereas Kahneson, Taylor, and Tversky were the founders of the behavioral finance. Now coming up with impact of behavioral finance on market. Here I'm going to find out the bubbles and the crashes that invested, the poor investors' return, and the market anomalies. According to it, what we are finding it is behavioral biases significantly influence the finance market by causing irrational investors' decision, which led to bubbles, poor returns, and market inefficiencies. Bubbles and crashes occurs when we goes on with the herd behavior or with overconfidence, which causes the investors to follow the crowd and believe the prices are going to keep rising. This leads to the formation of the market bubbles where the assets price rises far above their true value. The various examples of bubbles and crashes are dot-com bubble, which happened in the year 2000, the cryptocurrency market crash, and SME IPO crash that happens in the year 2024. When the reality sets in, fear replaces greed. The reality sets in fear, whereas it has been replaced by greed, causing a panic selling. This results in sharp market crashes, often pushing the prices below their fair value or overshooting. Under the poor investors' return, when the market performs well, investors often earn lower returns due to poor decision making. Example, market return is 14%, whereas the average investors that they have got the return is 8 to 9%. Why not 14%? So this gap of 5 to 6% is called the behavioral gap. That is the annual loss that they are occurring. No doubt they have already gained 8% or 9%. But as per the CAGR report, there is a loss of 5 or 6% individual basis. The next is, why does this gap occurs? Buying at a higher price due to FOMO, fear of missing out, selling during a panic selling due to fear, or over trading due to overconfidence. Maybe any of the three, amongst these three reasons, there can be any reason for this poor investors' return. The next are market anomalies, which goes on with the behavioral biases, which creates predictable pattern in market known as anomalies, which contradict efficient market theory. Key anomalies are momentum. Momentum effect means a stock that performed well in the past will continue to perform well in the future as well, which are driven by herd theory or herd behavior or underreaction. January effect means stock prices tends to rise in January, caused by tax loss selling in the month of December. Fresh investment in the new year. January effect. We always make our tax loss selling in the month of December or in the month of Jan because we have to close the year by the end of March. Our financial year ends. So there is always a January effect. Speed, the post earn drift for weeks, which means stock prices continue to move in the direction of earnings new for weeks. That shows that the market do not adjust instantly. The final takeaway from all of this impact of behavioral finance on market means market bubbles and crashes, lower investors' return, and persistent market inefficiencies. Markets are not very perfectly rational. Human emotions and biases create the cycles, mistakes, and predictable patterns. Now, coming up with the crash of crypto. Crypto 2018. This is the case that I'm going to take. It has been a very interesting case. It refers to a major crash in the cryptocurrency, which market makes the market following the massive boom of 2017, often called as crypto bubble burst. What had happened? In 2018, the cryptocurrency crash occurred after a period of extreme price growth in 2017, where digital assets like Bitcoin reached to record high. Prices were driven largely by speculation, hype, and investors' excitement rather than fundamental values. However, in 2018, the market supply corrected with Bitcoin, losing around 80% of its value, and many other cryptocurrencies experiencing even steeper declines. This crash was caused by several factors, which includes the government regulations. In India, we said Lakshmi is going to be come up into existence. We are not going to follow with the cryptocurrency, or the sell and buying of cryptocurrency will not be allowed here in India. Concerns about frauds, especially by ICO scams, the realization that many crypto projects lacked the real utility. As confidence declined, investors began selling rapidly, leading to market-wide collapse. Under behavioral finance, why are we reading this cryptocurrency scam or crypto fall of 2018? Because it was the result of herd behavior. Investors followed the crowd during 2017, the boom period, mass buying and pushed price unrealistic high. There comes the FOMO, fear of missing out. Everyone was having that FOMO, that my friend is going to earn 8% or 10% of the amount, and I will be losing that amount. I won't be getting the amount. So they have taken the loans from their friends or for some credit cards or somewhere XYZ places, and then they have invested in cryptocurrency. People invested just because prices were rising. Many entered in the market at the peak prices. They were having an overconfidence. They believed that the prices would keep on rising immediately. The confirmation bias was they ignored the warnings about the risk and scam. They were not having about that. And it was having, at last, when it burst out, that bubble burst out in the year 2018, it was the panic selling fear. When the prices start falling, investors rushed to sell, which accelerated the crash. Many cryptocurrencies lost most of their value. Several projects disappeared. Market took years to recover. So crypto 2018 shows hype, emotions, herd behavior that can create bubbles, and how fear of FOMO can cause a sudden crash. Uh, Dear everyone, I'll be going on due to shortage of time. I'm not in a situation to go on with certain cases, like the case of Harshad Mehta, the case of .com bubble, the IPO case, IPO scams. There are certain other cases as well that I would like to continue in a next session, whenever, as and when I will be getting the dates from BETKAR sir. Till now, if there is any question, please let me know. Here I'm just making up a pause for my presentation. No doubt I'm having 72 slides with me for whole of that behavioral finance, because this is one of the interesting topics that each and every investor, each and every one should know before investing. And amongst us, the total number of crowd, what I am thinking, that can be my personal opinion. Each and everyone is having their own डीमैट account. दिन भर में, महीने भर में एक ना एक ट्रेड तो करते ही नहीं. कुछ तो शेयर खरीदते हैं. हमारे दोस्त बताते हैं, बच्चे बताते हैं, कोई XYZ आके बता देता है, पड़ोसी बताता है, हम उस IPO को खरीद लेते हैं बेस्ड ऑन बिहेवियर. Any other question if you're having, please let me know.
Thank you, Dr. Puja Kaushik, madam. It was a very detailed, studied speech on the behavioral finance, right from definition. What are the biases? How the situations of war like this affects on the marketing? How we blindly believe on some friend decision or some advisor, as you have said that, and you have correctly said that advisor without any investing, he just gives advice, and we blindly invest it. So it was very detailed, interesting story of behavioral finance you have explained here. And next part, we are eager to listen from you in future within soon few days. We are very much thankful, and I request participants they can discuss also if you are interested in these things, investment, risk, all these things. You can discuss on these points with our speaker. Thank you.
Yes, Mr. Shukla, you have raised up your hand, sir. May I know?
Yes, doctor sir.
Yes, sir.
Good evening, good evening, ma'am. Wonderful presentation you have made, and I think it is a wonderful combination. The you have discussed. It is a new subject for me. Like finance is one side, on other side the behavior. So one side psychology is there, and other side the economy is there. So these two, amalgamation of these two subjects, what you have presented, very well presented. And what I could learn from this is, it is very dynamic phenomena, and it is influenced by so many factors. So it may be, the cognition of the person, understanding of the person, that is also playing a role, or maybe the influences from the society that is also playing a role, or the political parties what they are playing, that is also one role. Society is also one role. So I think it is a very dynamic phenomena. We used to crack a joke on it. Is like, the fever is like a share market. Sometimes the fever rises and sometimes it comes down. So
Yes.
that is why it is so, you'll find the share market is unpredictable, what we can say. I've seen some people, engrossed like addiction, with the share markets, sitting on the screen, some of my friends, and they are just watching, that screen are going up and down and all those red, green lines. And I'm real fascinated to see them, why so they are so much interested in this. Some people are having, 3 hours, 4 hours, 5 hours, they are sitting in front of the screen. So that is also one kind of behavior. What I can feel, that is a financial addiction, or maybe the share market addiction, not financial. Also, the loss and the benefit is not a big thing for them. But to know, which share is coming up and going up, and what has happened and why this will happen, and then I'd seen another category of people. Once they start acquiring the knowledge of share market, they become a resource person for the training for share market. And the
At
next
least on
step,
YouTube.
yeah, new madam, I've seen, people are earning on that, so they
Yes.
are having a wonderful coaching classes about the share market, and people are paying also. And another very important thing, the next step is, they start collecting money from the people, and then they are guiding them, so that is another very important thing. People rely on them, they are giving money, and these are becoming what we can say like
It
a
goes to
financial
another
agent.
Harshad Mehta.
Yeah, financial agents or something like that. And we don't know whether,
We, yeah.
means if someone is having a degree in finance or something, that we can understand. But even an IT sector person learn about, share market, and then he's having his own, money track and this and that. This is also one kind of behavior. And I don't know why the people follow them. That is also a big thing. I've seen, so many people lost their money keeping faith on them, because they are not putting a realistic view, but they are just praising because, and showing something, great to the customer. And mind you, somewhere they fail, and then they have to hide their faces. And so many things are there. So it is related with the legal aspects also. So all compliance and everything happens. And another phase, another behavior what I had seen, some people are having a lottery method. Lottery method means they put money, in without much thinking, and they are putting it, बोलते हैं ना, जुआ खेलना, that kind of things. And plus to that, now in Nasik city recently we are having so many problems, right? And the Babas and the Bhondu Babas, they are also guiding about the share market, and the people are putting it, the Baba ne bola hai और धागा बांध के दिया है, and they are putting it. So what we can say about this share market, it is so terrible, right? But I think the logic thinking, studying all these factors, if a personal investment is there, that I think that is a more important what I can feel rather than getting influenced by all these aspects. And अगर मैंने पैसा लगाए, मेरा डूब गया, तो मैं मेरे वजह से डूब गया है, at least that satisfaction will be there, right? Because when we are in a share market, नैया एक तो चलेगी या तो डूबेगी. These are the only two options are there, right? They are going up and down, and mind the marriage season is. They are going up and down, and mind the marriage season is there, and this and that. All people are worried that it has almost reached to 2 lakhs. Right now, it is somewhere. It has came down to 1 point. I mean, 1,53,000 or 54,000 maybe today. So such a what we can say. People means they purchase gold, and maybe in 2 months, it has come down. Right. So what you can think about, that gold purchasing, silver purchasing, what should be our behavior, because if we want to invest, right now, the consumer is in a dilemma. So as an expert, can you comment on this? Thank you.
I'm not an anchor. I won't be making any anchoring effect on it. But as per my own opinion, that I would be willing to do that is I will be buying the assets, the gold or silver or any sort of metal transaction, when we are thinking about earning profit. That concept should not be for a very short period. The first thing. If I am investing it at 1,53,000 and tomorrow I am finding it out, it has fallen down to 140. So there shouldn't be any panic. We should hold that for a while, because that metal price will not comes to zero. Taking the value of that particular product. Not today, not tomorrow, maybe after an year, it will recover or it will move up. The fluctuation in the prices is not because of the public buying. It was just reason of the war-like situations that we were facing, and number of countries were buying. There were certain banks, the private aided banks, that were buying the gold. We all were buying the gold from it, but they were not having the reserves of it. There was a notification by RBI as well, need not to buy the gold or any other sort of metal, silver, from any unorganized ones. If you're buying it online, e-gold is there, e-silver is also there. You need to buy it from them. That and number of things. Indian history, Indian mythology, we all females love to have gold. Jitna bhi wo kam hai. We make that price high.
Yeah, definitely. That is also one of the psychology we have to understand. And I think if you'll make a study and PhD also, there will be no end to this study. Thank you.
Yes.
Thank you very much, madam.
This is a new topic that is coming up. That is the only reason why I'm looking for one more session on it. It is a topic that has been added up by SWAM as well as by various other universities and different other colleges, by India renowned ones as well. So that under the heading of mutual fund, we used to write, think before investing, they are concept to market risk. But in share market, we are not reading those precautions and we are investing in. There has been around 60% of the investors who are losing their money. Hence, it is a current topic that is coming up, and everyone should be aware about it. Thank you.
Yeah, definitely. The awareness is the biggest key for this. And, one should enter into the swimming pool, then only you swim. Otherwise, don't take a help of others to swim. Then you may sink anytime. So, with this note, I think I will conclude. Thank you, Dr. Betkar, sir. And thank you, ma'am, Dr. Puja, ma'am. Wonderful presentation, ma'am. Thank you.
Thank you, sir. Thanks goes to BETKAR, sir, for giving me this platform so that I can speak in front of you all. Thanks a lot.
Thanks, Dr. Sir, and thanks to the speaker. Again, one participant is willing to ask Abdul Alim, sir, please.
Yes, Abdul, sir.
And good evening.
Good evening, sir.
Actually, I'm doing a research on same particular topic, behavioral finance only. So, behavioral financial analysis of investment pattern among millennials as well as Generation Z. So, this is my topic. Yeah, this is my topic where I'm doing research. Actually, my doubt is which behavioral biases, as per you, which that most dominant among millennial investors, ma'am?
Millennials are basically based on they belongs to the age group little higher age groups. They don't have that ample amount of time to go with that news and all. So they are most based on herd behavior or anchor effect that I am finding out. Whereas Gen Zs are more inclined towards taking up the risky factors. Gen Z are very risky enough. They are not inclined to one thing and they have that FOMO. What I am finding out as per their characteristics.
Yes,
Maybe we'll be getting the proper answer by getting up a sample survey clicked through various millennials and Gen Zs.
yes,
Based
ma'am.
on that analysis, we are going to find out the correct conclusion. It may be my prediction, maybe I may not be 100% correct.
Yeah. So, and nice presentation what you have given, ma'am, today. So, it was
you,
more helpful even for my PhD as well. And thanks for the BETKAR, sir.
Thank you. Thank you, sir.
Thank you, ma'am. Thank you, ma'am.
Thank you, Abdul Alim, sir. Kindly join every day these topics. If it is useful for the PhD, it will be very happy to us also that such things, academic things, should reach toward the researcher and get references, studious references, authentic references from the studious speakers. Thank you, sir. And I'm
Thank you,
thankful
sir.
to
Thank you, sir.
today's speaker, ma'am, also. In future, within early few days, she will speak the next part of this. So
Sure, sir.
now I'm thankful to her and thankful to all of you. Kindly fill the feedback link, please.
Thank you, everyone. No doubt I have taken ample of your time. And maybe in the nearby future, whenever I'm having a session once again, I'll be in a better situation to impart some more extra knowledge to you that I'm having and making it more interactive. Thanks, everyone. Thank you.
Thank you, ma'am.
Thank you to all participants, and they are requested to fill the feedback link which is available in the chat box. Participants. Thank you, ma'am. Thank you.
Thank you, sir. So may I leave or I need to be
Yes,
there?
yes,
Thank you,
please.
sir.